ICICI Nifty Bank Index Fund. Should you invest in this fund? Will this help you reach your financial goals? Who can invest in this fund and who should avoid this fund? Let us analyze. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions so that you can reach your financial goals faster and smarter. To analyze about this fund, we have to understand the key features of this fund, investment objectives of this fund, investment strategy of this fund. Let us start. ICICI Mutual Fund is the second largest mutual fund company, managing around 70 plus mutual fund schemes with an assets under management of 4.8 lakh crores. This particular NFO is ending on 24th February 2022. This comes under index fund category. The benchmark index is Nifty Bank Index. We have to understand the investment objective of this fund so that we will be having an in-depth analysis on this fund based on the objective. This fund would like to generate returns by investing in the basket of Nifty Bank Index stocks, expected to generate long-term wealth subject to the tracking error. This fund will simply replicate the Nifty Bank Index. Nifty Bank Index has got top 12 banks. This fund will have the same weightage of stocks as of the index. One important key observation about Nifty Bank Index is in the last 15 years, Nifty Bank Index has outperformed both Nifty 50 and Nifty 500. Now, the next question comes to our mind is, okay, does the banking sector worth investing in it? Let us see the factors positive for banking sector. The demand for banking services is expected to go up because of growing disposable income and increasing rate of working population, and broader indices like Nifty 500 and Nifty 50 has higher allocation to banking sector. Indian fintech market is expected to reach 6.2 trillion rupees by 2025, and low NPA, high interest rate margins are another positive factor for banking sectors. As we have understood the basic structure of this fund, investment objective, investment strategy, now let us list down the key observations in favor of this fund. What are all the advantages of this fund? This fund is diversified across top performing banks in India. The asset quality of banks is improving due to various reforms. Investors who are seeking for allocation to banking sector with a low expense ratio can definitely consider this fund. If the banking sector performs and delivers good return, then this fund can also deliver good returns. As we have seen, Nifty Bank Index has outperformed Nifty 50 and Nifty 500 in the last 15 years. This fund is a passively managed fund, so fund management expenses will be low compared to an actively managed fund. This fund is suitable for aggressive investors who are bullish on banking sector. All right, because it is a sectoral fund, you should know when to exit and when to enter. So if you are bullish about this theme and you are an aggressive investor, then definitely you can consider investing in this fund. What are all the key drawbacks in our observation? Let us list down. For a short-term investor, investing in any equity fund is riskier. Again, this fund invests in banking stocks, so not suitable for short-term investors. As it is a sectoral fund, focuses only on a particular sector, this fund is not suitable to your core portfolio. because it is not well diversified. This fund simply replicates, mirrors the bank index. So this fund will not be able to beat the index and deliver better return than the market. Not possible for this fund. If you are expecting alpha generation, then this fund is not for you. This fund may outperform its index due to fees, expenses, trading cost, and tracking error. There's a possibility. This fund is not flexible and dynamic when compared to an active fund. In the active fund, the fund manager can pick and choose the stocks as well as sectors. If one particular sector outlook is good, he can have overexposure on that particular sector. If that sector outlook goes down and there is another sector's outlook is brighter, he can move the allocation to the another sector. As this is a sector specific fund, this fund will not flexibly, dynamically manage or change allocation from one sector to other sector. The onus of changing from banking sector to other sector is with you. So you should have the ability to time the banking sector's outlook. When the banking sector will do well, you should have the ability to time it. Then you can enter. Similarly, you should also have the ability when the banking sector will underperform. You should have the ability to judge this. Then you will be able to exit. So entering and exiting from one particular sector is basically the responsibility of an individual investor. Whereas in a diversified equity fund, this responsibility is taken by the fund manager. He moves in and moves out of a sector based on the outlook. Here, such flexibility is not available. Because it is a sectoral fund, this fund can add more volatility to your portfolio. Because this fund represents only banking index, they will concentrate their entire portfolio on the banking stocks. So this is not a healthy diversification. If the banking sector underperforms, then this fund will definitely underperform. Fund manager has no other choice to stick to banking stocks, even if the outlook is poor for banking sector. This is a curse of this fund. Being a passively managed fund, this fund will not do any analysis on the underlying stocks. No, there is no analysis on this underlying portfolio. The fund manager will not read the balance sheet, not look at the soundness, not look at the sustainability of these banks, nothing. He will simply look at what are all the stocks in the banking index. He will buy those stocks in the same weightage. No fundamental analysis. So why do we go to a mutual fund? Because there is an expert who will be managing our portfolio. Here, his expertise is not used completely because he simply buys the entire index. He is not picking and choosing the best banking stocks. No. In a actively managed banking sector fund, the fund manager can pick and choose the best banking stocks based on his research, based on his analysis, based on the soundness, sustainability of the company. He can choose. Whereas in this fund, the fund manager is not having that freedom. He has to buy the entire index, all the banking stocks in the index. In the same proportion, he should be doing it. Now we have listed down the drawbacks, cons of this particular fund. Now, the final question comes to our mind is, okay, tell me, do I have to invest in this fund or I should avoid this fund? It depends upon what kind of investor are you. Yes, it depends upon you. If you are a first-time investor and a conservative investor, then definitely this fund is not for you. You have to definitely choose a well-diversified portfolio. This fund is a sector-specific concentrated portfolio. Being a first-time investor or a conservative investor, you should avoid this fund. There are existing Nifty bank index funds with less expense ratio and less tracking error. But in this fund, the ability to maintain the less expense ratio and less tracking error is not tested yet. We have to wait and see their track record. Then this fund is obviously not suitable for investors who are looking for market beating returns or dynamic fund management. This is not suitable. This fund is suitable for an aggressive investor who would like to invest on the experimental basis, who want to experiment with newer investment opportunities. Then you can try this fund with a minimum investment. Having said that, if you have any further questions with reference to this fund or any other investment options, we offer a free appointment with our financial planner. The registration link for the free appointment is given below this video in the description box. You can take advantage of that. Would you like to attend insightful investment webinars? We host regular free investment webinars. The registration link for the upcoming webinar is given below this video in the description box. You can register and learn how to create wealth through different investment options. Last but not the least, if you like this video, please give a thumbs up. If you're not subscribed to our channel so far, please subscribe so that you will not miss any of our future videos. Do you have anyone in your social circle to whom this video will be of use? Please share it with them. Thank you. Bye.